On February 20th, the Supreme Court did something nobody expected. In a 6-3 decision, they struck down the tariffs that have been reshaping the American economy for the past year. Not some of them, the big ones. The ones imposed under the International Emergency Economic Powers Act. In one ruling, the effective tariff rate on U.S. imports dropped from 17% to 9%. That's hundreds of billions of dollars in trade costs, wiped out overnight. But here's what the headlines won't tell you. Your portfolio just changed. Some of your stocks are about to do very well. Others just lost their edge. And there's a 150-day countdown ticking right now that most people don't even know about. Let me break down exactly what happened, who wins, who loses, and what you should do about it. So what was IEEPA? The International Emergency Economic Powers Act was designed for national emergencies, sanctions, asset freezes, that kind of thing. It was never meant for trade policy. But the administration used two words in the statute, regulate and importation, to justify sweeping tariffs on imports from nearly every country. Chief Justice Roberts wrote the majority opinion. His key point, those two words cannot bear that weight. IEEPA never mentions tariffs or duties anywhere, and if regulate meant tax, then IEEPA would also let the president tax exports, which the Constitution explicitly forbids. 6 justices agreed. Kavanaugh wrote a 63-page dissent. And just like that, the legal foundation for the biggest tariff regime since the 1930s collapsed. Here's what changed in numbers. Before the ruling, the trade-weighted average tariff rate was about 17%. That's the highest the U.S. has seen since 1946. After the ruling, it dropped to 9.1%. But, and this is important, not all tariffs went away. Section 232 tariffs on steel and aluminum at 50%, still there. Section 301 tariffs on Chinese goods, still there. What got struck down were the broad IEEPA tariffs that covered everything else. And within hours of the ruling, the administration pivoted. They signed an executive order imposing a new 15% global surcharge under Section 122 of the Trade Act of 1974. Here's the catch. Section 122 tariffs expire automatically after 150 days unless Congress votes to extend them. That puts the expiration around July 24, 2026. Mark that date. Before we talk about stocks, you need to understand who was actually paying these tariffs. Goldman Sachs found that consumers absorbed about 55% of tariff costs. Not foreign countries, not China, American consumers. A Harvard study showed that the cheapest products got hit the hardest. Prices rose at twice the rate of premium goods. And the Yale Budget Lab calculated that the bottom 10% of earners paid about 3 times more as a share of their income compared to the top 10%. In other words, tariffs hit the poorest Americans the hardest. What did this mean in dollars? The average household was paying an extra $1,200 to $1,600 per year because of tariffs. Post-ruling, that drops to roughly $600 to $800, assuming the Section 122 replacement expires on schedule. Now, you might have heard about $175 billion in potential refunds. That's real. But here's the catch. Those refunds go to businesses, to the importers who paid the tariffs, not to consumers. And Goldman found that only 18% of companies surveyed would fully roll back their tariff surcharges. Another 34% said partial rollback. The rest, they're keeping prices where they are. The tariff created a new price floor, and most companies aren't giving it back. So, who benefits the most from this ruling? Companies that were paying the most in tariffs. Let's go through the biggest ones. Apple was paying between $800 million and $1.1 billion per quarter in tariff costs. That's $3.3 billion in 2025 alone. They'd already started shifting manufacturing to India and Vietnam, but the IEEPA tariffs were still a massive drag. On the day of the ruling, Apple was one of the best-performing Dow stocks. Retailers got crushed by tariffs. Walmart absorbed an $880 million hit, and analysts estimate they're eligible for over $2 billion in IEEPA refunds. Nike was staring down $1.5 billion in annualized tariff costs with a 120 basis point margin headwind. Best Buy slashed their revenue guidance to $41 billion as margins compressed. E-commerce popped immediately. Etsy surged 8% on the ruling day, eBay up 3%, Amazon up 2%. The auto sector might be the biggest winner. Hyundai's operating profit fell nearly 20% in 2025 despite record revenue. Tariffs shaved roughly $2.8 billion off their bottom line. Kia's profit dropped 28%. Combined, they absorbed almost $5 billion in tariff-related losses. Ford estimated a $2 billion net loss from trade policy. GM warned costs could reach $3 to $4 billion. Wells Fargo published a comprehensive list of beneficiary stocks, 24 names including Nike, Target, Home Depot, Dollar Tree, Caterpillar, Deere, UPS, and FedEx. Their thesis: own sectors going into the restocking cycle. When tariffs drop, imports surge, and logistics companies move first. Now for the other side. Who loses when tariff protection disappears? The obvious answer is domestic producers who benefited from the tariff wall. U.S. Steel and Nucor came under pressure as cheaper international materials become competitive again. But here's the nuance. Their main protection, the Section 232 tariffs at 50% on steel, was not affected by this ruling. Those remain in full force. The real losers are companies that built domestic capacity specifically because of IEEPA tariffs. Manufacturing actually lost 59,000 jobs since the tariff announcement, despite being the supposed beneficiary. Most companies were doing what analysts called a tariff tap dance, making only defensive, reversible adjustments because policy could swing overnight. The few that made big irreversible bets on domestic production are now stranded. Here's what makes this complicated. The Section 122 replacement tariff at 15% is temporary. It expires automatically on July 24, 2026. That's about 140 days from now. Congress would need to vote to extend it. And given the current political dynamics, that's far from guaranteed. If it expires, the effective tariff rate drops further, from the current 13% down to 9%. If Congress somehow makes it permanent, we're stuck at the higher level. The economic outlook hangs on this countdown. The Yale Budget Lab estimates that without the IEEPA tariffs, the long-run GDP hit drops from negative 0.3% to just negative 0.1%, saving about $60 billion per year in economic output. Unemployment projections fall from 0.6 percentage points higher to just 0.3 points higher. Goldman Sachs is forecasting U.S. GDP growth at 2.5 to 2.6% in 2026, above the consensus of 2.0 to 2.1%. They see reduced tariff drag, potential tax cuts, and easier financial conditions. The Fed is expected to cut rates to 3.25% as tariff-related inflation fades. But Goldman also warns about price stickiness. Prices went up fast. They won't come down fast. Only 18% of companies would fully roll back surcharges. The tariff era created a new price floor. Here's a simple framework to check your own portfolio. 3 questions for every stock you own. First, where is the company's manufacturing? Domestic means they were protected by tariffs. International means they were paying them. Second, where are inputs sourced? A company can manufacture in the U.S. but still import raw materials at tariff prices. Third, does the company have pricing power? Can they pass costs to customers, or are they stuck absorbing them? Companies with domestic manufacturing, diversified supply chains, and strong brands, like Caterpillar or Apple, are resilient either way. Companies with China-dependent supply chains, import-heavy models, and low pricing power, like discount retailers before the ruling, were getting crushed and now get relief. Concretely, here's what I'd look at. Check if your holdings are on the tariff refund list. Importers who paid IEEPA duties may get back billions. Watch the July 24th expiration. If Section 122 expires without replacement, that's another catalyst for import-heavy stocks. And pay attention to the restocking cycle. Wells Fargo's thesis of owning logistics and retail into the restocking wave makes sense. The one thing I wouldn't do? Panic sell domestic manufacturers. Section 232 and 301 tariffs are untouched. Steel, aluminum, and China tariffs aren't going anywhere. The Supreme Court just rewired trade policy. Whether you think tariffs were good or bad, the investment landscape has shifted. The companies that were paying the most just got relief. The countdown to July is ticking, and the market is already repricing. If this was useful, subscribe. I break down how market events actually affect your portfolio, not just the headlines. See you in the next one.